Okay, good morning. My monitor tells me we're live, so I hope we're live. Good to see everybody. Let me know if you're out there. It is the 20th of November at 10 o'clock, so it's time for our weekly webinar. So we haven't done a one-on-one in a few weeks. We had some great guests over the past couple of weeks, and prior to that, I was away. I attended the Ed Slott's Master Elite Advisor Group. Yeah, Master Elite Advisor Group out in San Diego. And I brought home the manual to share with you folks. And, this is the manual from this semi-annual meeting. And I'll just share with you, these are some of the updates and whatnot we go through. And you see, I like to tag things and keep this around for reference because I had new regulations about year of death RMDs. I have trusts. I have, let me see, some of my other RMD statute of limitations, penalty, the statute of limitations on the penalty. Let's see what else we have. Some legal updates from Shannon, new RMD aggregation rules. So there was just so much over those 2 days. And I love spending time there. I love getting these updates, spending time with the folks in the room, some of the sharpest and brightest people around the country. So, and then we had that time, that period of time I wasn't here. And then we also had two great guests. We had Brian Adler. We talked about aging in America and some important topics around that. And then last week we had Heather Schreiber, our Social Security analyst. And boy, isn't Heather great. Brian's great too, but it's so great having Heather on our team. And, we really get to dig into different Social Security strategies and out of the box thinking around that. And sometimes she brings things to us that I wouldn't have even thought of. And we just had that situation with a client last week where we were talking about claiming strategies and she said, well, you should maybe think about this. And honestly, folks, it was something that hadn't occurred to me that's going to result into significantly more money for the client over their lifetime. So that's really great to have Heather as part of our team. And I think you got a taste of it from that webinar. And I'll put the links in the description for this week. If you if you didn't listen to them, then go back and listen to them. And if you're on our email list, you get the recordings when they come out. If you're not on our email list and want to, you can go to questions@attabourwealth.com. That's questions@attabourwealth.com and request to be on the email list, or just go to our website at attabourwealth.com, and there is an opt-in under webinars on the website. And we are redoing our website again. We just redid it last year, but it's time to update it again, and I'm excited for some of the updates that are coming for you folks to make it a little more interactive and maybe easier to use. There's so much information that sometimes it gets lost out there. Okay, but this week we're going to talk about Roth conversions and annuities. So this came out of a topic, the conversation with a client, just like many of these webinars and podcast topics do. And if you haven't listened to our podcast yet, you can go to Not a Guru podcast. But we're going to talk today about, Roth conversions and annuities. We are deep in Roth conversion season. So we start our Roth conversions, really, or throughout the year. We're planning and completing that for some people, but most people wait until the end of the year because we're collecting information about their income and bonuses and things like that. The majority of our Roth conversions are done between September and the end of the year. Maybe mid-August they start. So we're deep in it right now. And if you're a client of ours and is listening, and if we're waiting for information from you, please get it back to us as soon as possible so we can get things done for you. But one of the tools that we use often are annuities in our financial planning and investment management. So there are conversions that are done, of course, in annuities, and we're going to talk a bit about that. And they can be complex, and it's important to remind people how that works. And I want to remind you about the goals that I have for you as our listeners. I want you to be inspired to make changes. I want you to open your mind to different ideas and ways of thinking about planning and investing. I want you to stay educated so you feel confident in the plan and strategies that are put in place. And, of course, stay updated so that you can make adjustments along the way. There's things that we do year over year with little tweaks, and there's big changes that we make year to year, and you've got to So you've got to make those changes sometimes to make things better. Okay, so let's talk. We talked about our past guests. Let's talk about some headlines. So everybody's been asking me about the election. So here we go. We've come and gone from the election. You're either happy or not happy. But the situation is, I'm not gonna spend time talking about the individuals or anything else. But the common question I get, okay, well, what about tax rates now? What's going to happen with tax rates? And the reality is, my opinion has not changed about tax rates. So a few years ago, I started telling you that I thought the tax rates that we have today under the Tax Cuts and Jobs Act that's set to sunset at the end of 2025. Just about everybody knows that at this point. So at the end of that sunset, the tax rates are set to revert back to 2017 levels. But I had started talking several years ago, or at least a couple years ago, that I believe that the tax rates will be continued in some manner. The tax rates that we have in the middle for most of the middle class and where most people pay their taxes, that 22 to 24% marginal tax rate would be continued in some manner until a time when it just can't continue anymore. Right, that when the the cork pops or the dam breaks or whatever your analogy is, there's going to be a point where taxes have to increase. But it really didn't matter, it seemed, who won the presidency, the House or the Senate, because all of the candidates were talking about the same thing. Certainly the presidential candidates, they were saying that, well, we have to continue these tax rates. We don't want to raise taxes, maybe on certain people, but not others at certain higher income levels. But what was very clear is that where most people are affected, that was going to continue. So the outcome of the election really meant nothing. In my opinion, the tax rates will likely continue. Maybe the upper tier tax rates, if Republicans, now that Republicans have control of the White House, Senate, and the House, maybe that even the top tier rates won't change much at all. But certainly those middle rates are very, very likely to stay very much the same, might even get reduced. Who the heck knows? So that's my opinion about the future of tax rates regarding the election. Another headline that we saw today, so this came out yesterday, was home sales. So housing starts, they're called, declined 3.1% in October. Housing starts declined a total of 1.311 million, an annual rate, lagging what everybody thought was expected. They are year over year down 4%. The decline in October was entirely due to single-family starts. So what that means is new construction. Multifamily starts rose in October. In the past year, single-family starts are down 0.5%, and multi-unit starts are down 12.6%. October fell. The starts fell in October in the South and Northeast, but rose in the West and Midwest. New building permits declined 0.6% in October to 1.416 million, annual rate lagging what everyone thought. The consensus expected 1.435 million. Compared to a year ago, permits for single-family homes are down 1.8%, and permits for multi-unit homes are down 18.2%. And believe it or not, mortgage rates are up again too, right? So they're nearing 7% again. So even though the Fed continues to cut, the market is pushing the interest rates back higher. So all these things are going to affect home purchases. So we're seeing a decline in home purchases, whether it's new homes or existing homes, and certainly more so on first-time homes. I was reading earlier today that there was discussion about where these homes are located, and there's only so much land to build on that's close to highways and metropolitan areas. So as we go out further, it's much more challenging. People have to drive further to live in their homes. Therefore, they have costs associated with commuting. They have costs associated with commuting. Even the builders, they may have less of an opportunity to hire builders to build these homes or hire employees to work on the building of the home, because if someone has to drive a couple hours to get to their job site, well, that costs money. So these are all really important considerations when you're thinking about these housing starts in the new building. All right, so that's headlines. Let's jump into our slot report. So we're going to, and I didn't talk about upcoming, I talked about previous guests we had, but let me go back and talk about our upcoming guests. So when I was out in San Diego, I scheduled some time coming up in December. We haven't quite locked in a date yet with Sarah Brenner, who is the Director of Retirement Education for the Ed Slott Master Elite Advisor Group. We've got a couple topics we're kicking around. We'll see where we are when we get closer. But I'm excited to have Sarah back on this webinar to talk about the topic of the day. And then in January, we have Andy Ives, who is an analyst in the Ed Slott Master Elite Advisor Group, and I'm excited to have both of those. So we have December and January already lined up for you. All right, let's go back to our slot report, and you can read along with me here. So this first portion, let me put me, I think, up top. That might be better. Okay. So this first portion here is we're going to talk about qualified charitable distributions and required minimum distributions. And this is from our friend Sarah. So the question is, if an IRA owner, if an IRA owner is over 70 and a half, can they do a qualified charitable distribution or a QCD, even if their spouse makes a deductible traditional IRA contribution? Really great question. This person's name is Mark. That's not me. I didn't send this in. But good question, because QCDs, qualified charitable distributions, are a way to distribute funds from an IRA direct to a charity without paying any tax on that distribution. So there's a lot of rules around them. You have to be over 70 and a half years old. And this person's asking, well, wait a minute. If my spouse makes a contribution, can I do this? Can I still do a qualified charitable distribution if I've met the other requirement of being, in this case, over 70 and a half? Really great question. So the answer from Sarah is, hi, Mark. Again, not me. There are some complicated rules that count deductible IRA contributions made after 70 and a half against QCDs. However, these rules apply on a per-person basis. What a spouse does is not considered. Your spouse can go ahead and make a deductible traditional IRA contribution. It will not affect your QCD. Good answer. So good. Oh, Mark's happy about that. So here's the next question. In December of 2023, I requested a transfer of my IRA funds to a new custodian. The old custodian sent a check as a direct transfer to the new custodian, but as of 12/31, the check was quote unquote in the mail. For RMD calculations, do I just forget these in the mail dollars as they will be accounted for next year? Or do I add the value of the outstanding check to the 12/31/2023 balance to calculate my 2024 RMD from my IRA with new custodian? Boy, that's a good question. You know, RMDs are no joke. You've got to take distributions out of your IRAs after certain ages. And if you don't take your distribution, then you're subject to a penalty up to 25% of what you should have taken. So this person's asking, well, do I have to count it all, if the check's in the mail? So let's look at the answer here together. The answer is, hi, Ryan, the RMD rules do require you to adjust 12/31 prior year balance used to calculate RMDs for any outstanding rollovers or transfers. In your case, you would need to add the amount of the outstanding transfer into your 12/31/2023 balance when calculating your 2024 RMD. Now, let me add this, folks. If I'm sharing my screen, you can read along here with me. We call this the Kathy rule. So Kathy had suggested that we do this several years ago, and I think I've had feedback that it works for you. But if you're just listening on the webinar, either on YouTube or on the podcast, you might want to go to the video and read along with us. So the next bit, now that was questions and answers. This is a rather long discussion about Roth IRA conversions by our friend Andy Ives, who's going to be joining us in January. This is a bit of a long article. It's several paragraphs. I was debating whether I was going to share it with you because of the length, but I think it's very, very important to be reminded about these things. You're likely, if you've been listening for a while, you're going to hear some of these items and you're going to say, oh yeah, I know that. That's right. I've heard that before. But it's good to repeat these things, not only for you, but for us as well, but certainly for listeners and certainly for new listeners. So let's get back to this. So we're going to talk about these Roth IRA conversion considerations from our friend Andy Ives. Thank you, everybody. Good morning, Paul. Good morning, Keith. Thank you for that. So Andy writes, Roth IRA conversions remain as popular as ever. However, based on some recent questions we've received, it is apparent that folks don't fully understand all the nuances of this transaction. Here are some of the basic concepts and items of consideration. The first is there are no income limits on Roth IRA conversions. Yes, there are income limits when making a Roth IRA tax year contribution, but not on a conversion. A person could make $1 million and still do a Roth conversion, or a person could be unemployed with zero income and do a Roth conversion. If you reside in a low income bracket, just be sure you have the money available to pay the tax on the conversions. I'll add if you're under 59 and a half. Back in the day, there were income. Let me readjust that. Back in the day, there were income limits for Roth conversions, but those limitations have long since been repealed. There is no limit on the amount that can be converted. If you want to eat all the taxes due on a multi-million-dollar Roth conversion, go for it. For some people, this could be a wise strategy. Maybe their ultimate goal is to provide a tax-free inheritance to their beneficiary. Maybe they are sick of taking required minimum distributions, RMDs, and just want to rip the tax Band-Aid off. Whatever the case may be, a single gigantic Roth conversion is perfectly acceptable. There have been proposals to limit conversion amounts, but such ideas have fallen on deaf ears. So there are proposals that came out of Washington, out of the White House, just in March of this year that looked to limit the amount of conversions that you were able to do. There is no such thing as a prior year conversion. I get asked this all the time, folks. But let's restate: there is no such thing as a prior year conversion. There are prior year Roth IRA tax contributions, but not conversions. For a conversion to count for a particular year, the funds must leave the traditional IRA by December 31st. For example, if an IRA owner takes a distribution from his traditional IRA on December 31st, 2024, and deposits those funds into a Roth IRA early in 2025, within 60 days of the distribution, that will count as a valid Roth conversion for 2024. A Roth conversion will generate a Form 1099-R showing the distribution in Box 1 and a Form 5498 showing the Roth conversion in Box 3. Continuing with the example above, the distribution in late 2024 will create a Form 1099-R for 2024. But since the rollover conversion, quote-unquote, crossed tax years and wasn't completed until early 2025, Form 5498 won't be generated until 2026! Proper tax preparation is paramount to ensure the IRS knows what happened. An important fact for anyone under 59 and a half who does a conversion: taxes withheld on a Roth IRA conversion do not get converted. There is no age limit or penalty for doing a Roth conversion, only taxes do. But if a younger person has the taxes withheld from the IRA when doing the conversion, those taxes withheld are an early withdrawal and will trigger a 10% penalty on the money you are sending to the IRS. That is a bummer, and we don't want to put anybody in that position. And I've seen it, folks, people that get excited about this idea of Roth conversions, maybe are working with somebody who is equally excited but doesn't have the experience, and they make mistakes like this. One final interesting Roth conversion item is the ordering rules. We know that Roth IRAs can consist of 3 different types of dollars: contributions, conversions, and earnings. Ordering rules dictate that Roth distributions follow that exact sequence when paid out. A person always has access to their Roth IRA contributions, tax and penalty free. But be careful, a person could make a bunch of contributions to a traditional IRA and subsequently have a large amount of earnings in that traditional IRA. If this IRA were to be converted to a Roth IRA, those dollars would no longer be contributions and earnings, but would now be converted dollars within their Roth. This character changed as they are now slotted into the Roth conversion bucket within the Roth IRA. The Roth IRA conversion conversation can go on for pages and pages. I didn't even mention the 5-year Roth clocks, but be sure to consider the laundry list of Roth conversion items before haphazardly diving in. So, good information from Andy. I hope that was helpful. And I'll just caution you because, I just recently had a conversation with someone who came out of one of her classes, and she said, this happens a lot. I have I have a relationship with somebody at, I think it was Morgan Stanley. And they said, they've never talked to me about tax efficient planning or Roth IRAs or anything like that. And they don't seem to have an interest. When I've asked about it, they said they don't necessarily have a good idea or they don't necessarily think it's a good idea. Then they'll learn some items in class, maybe read some books and listen to these webinars for a while, and then they'll go back to their advisor and say, I was taught this. Sometimes when we meet with people, we do a general sketch plan about what a conversion strategy may look like, and then they'll come back and they'll say, well, my Merrill Lynch or Morgan Stanley advisor or whomever it is who's never talked to me about Roth conversions and isn't an expert in this area says he or she can do that for us. Well, that's a dangerous road to travel because there are so many potential hurdles along the way. So I'm not saying you have to work with us at Attleboro Wealth Management. I think we're very, very good at what we do, and we've received accolades from well-respected people. But you definitely want someone who's been down this road before, who's walked this road before with you. So that you can avoid the potholes along the way. All right, off of my soapbox. Let's talk about the markets. Crazy couple weeks, huh? So right after the election, we really screamed up, and then we had several days of decline. But we're going to talk about last week's returns. So we have the S&P 500, which was down just over 2% last week. The Dow Jones Industrial Average was down 1.17%. Now, the S&P, it was still up. As this is a close of business on Friday, which was the 15th, November 15th. The S&P 500, however, even though it was down 2% for the week last week, is still up 24.5%. The Dow Jones Industrial Average is up 17% still for the year. The NASDAQ is up 25%, and it was down last week at 3.13%. The international markets got hit a little bit harder. The MSCI was down just about 3%, close to what the NASDAQ was. The emerging markets were down 4.5%. So a lot of movement around the country, or around the world, and we've seen obviously some additional sell-off earlier this week. Not sure what's happening today in the markets yet. All right, so that's just a bit of a snapshot. Now, what's our analyst talking about? Well, looking back at last week, again, ending November 15th, we saw the Consumer Price Index report come in. Consumer inflation ticked higher to 2.6% from 2.4% year over year as expected. While the core rate matched the prior month's reading by rising 3.3% year over year as expected. Headline inflation was up 0.2% and core inflation rose 0.3% month over month. So the analyst writes, although the numbers came in as expected, the reading shows a slight pickup in headline inflation while the core rate remains elevated and higher. Investors, however, may have been fearing a worse number as the odds for Fed rate cut at the December meeting rose following the release. So we'll see what happens in December. Wholesale inflation, the PPI number, wholesale inflation came out. That rose 0.2% month over month and 2.4% year over year, the latter of which was slightly higher than expected, while core PPI rose 0.3% month over month and 3.1% year over year, which was also a tick higher than expected. Wholesale inflation, the analyst writes, doesn't get as much attention from investors as the consumer information, the CPI, but the Fed pays attention as wholesale prices can feed into what consumers pay, and a slightly warmer read will draw some attention from Fed members. We also saw retail sales. Sales increased 0.4% month over month, a little ahead of the expected 0.3% rise. And if you take out autos, sales were up 0.1%. Restaurant sales were up 0.7%. So the consumer appears to be in good shape heading into the holiday shopping season. We'll see Fed Chairman Powell noted this week that the strength of the economy means that the Fed doesn't need to be in a hurry to cut rates. Interesting. We talked about housing starts at the beginning. This Wednesday, today, we see NVIDIA earnings. We don't often highlight specific corporate earnings, but The previous earnings releases have been market moving events as of the past, recently. Tomorrow we have jobless claims. This forward-looking labor indicator is released weekly, but after falling to the lowest level since May, investors may pay a little more attention to this reading. All right, and I'm just going to share with you, I think it's important to share this chart that we have showing 12-month changes in the consumer price index. So this goes, you can't see the date on this, but this is 2025 because I'm blocking it. But down here in the bottom left, it shows, let me just see. You know what, I'm going to take me out of the picture. So you can see here's consumer price index. So we have core in the dark blue, and then the gray is overall 2.6. So you can see, we had many years, folks, of very, very low inflation, bouncing right around that 2% number. And then, of course, we jumped up during the pandemic to over 9%. And this is the sticky area here. So it's going to be really interesting to see. The Fed's target is 2%, and we're having a hard time getting to that level. Because I just reported to you that housing is coming down, right? Or we not coming down, but we see some softening in housing. Interest rates are up, but we're still seeing retail sales very, very strong. We know that people have less money to spend, or less savings, I should say, than they did certainly during the pandemic, because people were getting money and they were saving it or spending it, and that's why inflation spiked up. But that is continuing to wane, but we still see this sticky inflation, much better than it was. And we still see strong retail numbers. So it's going to be interesting to see how this plays out, not only just for the Fed, but also the markets as a whole. So I just want to share that chart with you because I thought it was interesting. Okay, this is the financial focus portion of our meeting. And if you haven't already, if you're just joining us on YouTube, maybe for the first time, or listening to the podcast, and there's no way to like it. I think you can like a podcast, but if you can, go ahead and like that. You can certainly follow it, and you can subscribe to the podcast. But certainly on YouTube, if you haven't already, hit the like, subscribe, and notification buttons. This way, whenever we release new videos, and we release them often, then you'll get notification. And today in this financial focus, we're going to talk about Roth conversions and annuities. So very, very simply, I'm going to share my whiteboard here. I'm going to first talk about Roth conversions. So we just got to go back to the basics a little bit. I'm going to go over here. So remember, you've got 3 different categories for your investments. So we have, you can think of them as buckets. We have taxable, tax deferred, and tax-free. So we're going to focus on these 2 right here. And tax deferred, for most of us, that's IRAs, traditional retirement plans like 401ks. And then tax-free is Roth and anything, some properly structured cash value life insurance. But today we're talking about Roth. So a popular and very powerful strategy, and we talked about it, quite a bit in preceding this in our weekly webinar, is what's called a Roth conversion. And that simply means that you're allowed to take money out of this bucket here and move it over to here. That's a distribution coming from your traditional IRA and a redeposit into your Roth IRA, and that's referred to as conversion. And the cost of that is the tax rate, right? So you pay your tax rate. So if you think the taxes are going to be higher in the future, then it may make sense for you to consider a Roth conversion. So very, very common strategy. So that's what a Roth conversion is. And you should go, if you have an interest in Roth conversions and you don't know this, you should listen to the weekly webinar portion of this if you haven't joined us from that. And we talk about some details around Roth conversions, or we got a lot of different videos about conversions. But those are the basics of Roth conversions. Now, let's talk about annuities. So there are many different types of annuities, and we've talked about that previously as well. But there are some benefits and trade-offs with annuities, and they're complex in structure because of these benefits, frankly. But many of them have some kind of market protection, and many of them have guaranteed future income. And one of the things I didn't add here was many of them have, they all have some form of death benefit. So again, annuities can be cumbersome and not helpful to your plan, or very powerful in your plan, depending how they're structured. But you've got to know your benefits, costs, and limitations, because there are few annuity companies that will allow you to effectively schedule Roth conversions over time. Now, when we think about categories, and if you're thinking about using an annuity, and just say your primary objective for your annuity is to have some level of guaranteed lifetime income for you, or for you and your spouse, you have to ask yourself, where would you like that income to come from? Well, for most people, that would be this tax-free bucket, right? You want that to be Roth. So whether it doesn't, it's just like a mutual fund in this way, or any other investment. The annuity is an investment on its own, and it has some tax consideration on its own. But if you own an annuity as an investment in the traditional IRA, you're going to pay tax on distributions when you take those distributions. If you own an annuity in a Roth IRA, any distributions have zero tax. Now, of course, you have to meet 5-year rules and things like that when you're talking about Roth distributions. But let's assume you've done that, and your annuity is these are qualified distributions, and you're paying zero tax. So if you had a choice to receive guaranteed lifetime income, for example, where would you want that income to come from? Would you want it to be taxed, or would you want it not to be taxed? Well, for most people, they'd want it not to be taxed. So a common strategy is, because most people have most of their money in this tax-deferred bucket right here, a common strategy is we'll allocate a portion of the investments within the tax-deferred bucket inside of an annuity. We like the ones that offer principal protection, guaranteed lifetime income, and, of course, a death benefit. You've again got to be careful of the costs and nature of it. But we'll allocate a portion of the holdings into an annuity and have a schedule to convert part of that annuity over time, because most people don't take $1 million, for example. Let's just say you have $1 million in this tax deferred bucket. Most people just don't convert that all at once over to Roth and pay a huge tax bill on the way. Most people say, okay, well, here's my $1 million. What if we convert it over time? And it's different for everybody. It might be 5 years, it might be 7 years, it might be 10 years. It depends on your situation. But here's where you've got to be careful, because there are some annuity companies, and I only know of 4 right now, that will say, hey, that's fine. If you have, let's just say $500,000 of your investments in an annuity, we'll allow you to transfer that over time. No problem. And we'll continue the same guarantees you have, continue the same start date that you have, and that can work quite well if that works for you. There are other companies. So we have a client that we took on this year that had a annuity already in their IRA. And let's just use the same example. And they had a $500,000 value, and they're receiving, or they can receive distributions based on a $600,000 value, because there can be some benefits that offer a higher value for income than their current value. So maybe I should talk about that. Let me step back for a second and talk about some basics around that. So when we talk about the potential benefit of using an annuity, so let's go over here. If we think about it this way, we have a current value or contract value of the annuity. So let's use that same value, $500,000. So just like a mutual fund, just like a stock or a bond or an ETF or something like that, it will have a current value. with a mutual fund, stock, bond, or an ETF, that current value is going to be, what you draw from. So if you want to draw income off of that, you figure out the income that you need off of that, and then you need $25,000, for example. That's drawn off of your $500,000. What annuities offer is as the annuity is growing, they offer a difference between the current value and I'm going to call it an income value. So every annuity company calls it something different, but I'm going to call this an income value. And I'm just going to refer to it as IV. Sometimes it's future income value, sometimes it's protected income value, but we're just going to refer to it as income value. So you might have an immediate value or a value that grows over time of, say, $600,000. So now you have a difference. So obviously the difference here is $100,000. Well, that in a couple of years that could be $650,000. Then it could grow to $700,000, and the different. Now you might be saying, well, heck, the mutual fund can also do that. If that was a mutual fund, that can grow over time as well. The difference with the annuities is these values typically are locked in. Once you hit that guaranteed value, then it can't go below that for future purposes. And of course that's the benefit, because a mutual fund. So now let's go over here and let's talk about a mutual fund as an example. A mutual fund or an ETF or a traditional investment, let's just say. Well, sure, that could start at $500,000 and that could grow to $700,000, and then we get a market correction, and it could correct back to $600,000. Where an annuity, depending on the structure of the annuity, of course, once you hit these levels, $600,000, $650,000, $700,000, as long as you follow the rules of distribution within the annuity, if the market crashes back down, you're going to be locked in at $700,000, for example. So you won't go below that $700,000 for your income value, or potentially even your death benefit, depending on how the contract is structured. So you'll see that there could be a value between the actual cash value of the investment, just like there's a value with the mutual fund, and this income value. Let's just now call it $700,000. So now the difference is $200,000. So this is where you have to be careful when you're considering placing funds from your tax deferred bucket in an annuity, because one of the questions you want to ask is, can I convert these funds, right? So number one is, can I convert? Can I move this from the traditional IRA to a Roth IRA? Now, the representative on the phone or the person sitting across the desk from you might say yes. But sometimes they say yes, and the but is sometimes it's, well, yeah, but you got to do it all at once. And that might not be what you want to do. So that $600,000 $500,000 cash value, you may not want to convert that entire thing. They may also say yes, but if you convert, you give up the guarantees. Now that one is very common, and that's the situation we have with a few clients. We didn't place these people, and we didn't recommend these annuities that they have. They have them already. But let's just say they have a $500,000 value, the existing value, current value, and their income value in this case, or even death benefit, that's a D, death benefit is $700,000. The annuity company might say, yeah, you can convert it, but now this $700,000 income value and death benefit goes away completely, and what you have left is the $500,000, and we're happy to put that in a Roth IRA for you. Well, that's problematic for a couple of reasons. First of all, you may be counting on that income, you may be drawing on that income, and you likely paid for that income somewhere along the way. There are few companies that don't attach fees to these income differences. So these are the things you have to pay attention to. I hope that makes sense. I hope that gives you some good background on that. So now, if you choose to convert a portion of your annuity if it makes sense, if it's allowable and it continues the guarantees, because there are just now 4 companies that I know that will in fact allow you to say, okay, we've got a $500,000 value, we've got $700,000 in future value, whether it's income value or death benefit. Now we want to convert a portion of it. So the $500,000 goes from traditional IRA to Roth IRA. So traditional IRA to Roth IRA, and but we do it over time. So let's just say 5 years. 1, 2, 3, 4, 5 years. So $100,000 a year. So what will happen there is it'll capture not only the $500,000, but also the difference in the guarantee. So when you're done, your entire $500,000 plus any growth you have along the way, will be now in your Roth bucket as opposed to your traditional IRA bucket, right? So tax advantaged or tax-free and tax deferred. Now that $500,000 plus growth and your $700,000 of future value, whether it's income value or death benefit, plus any growth, right, will reside in Roth. So that's the best way to handle it, right? So everything carries over. The guarantees carry over. We're not worried about blowing anything up, like all of a sudden we have to give this away, give away what we've earned and potentially paid for. And we also don't have a situation where we have to do one massive Roth conversion if that doesn't make sense to you, for you. But now there are ways to convert it over, but the devil's in the details. You got to have the right company for your purposes. And like I said, today there are only 4. I'm not going to name them because this is about education, not about, individual advice. So you got to be careful. You got to know your benefits, costs, and limitations. Pay attention to reduced or no Roth conversion options, elimination of benefits. And we want the proper placement. So the proper placement, I believe, let's go back to this. If we're talking about guaranteed lifetime income, if we're talking about tax efficient growth, where do you want those investments to lie? You want them to be in the tax-free, tax-advantaged side of the ledger, right? So any guaranteed income, lifetime income, ideally you want to be at zero tax there. So this is number 1 best place for your annuities to live is the tax-advantaged or tax-free side. Number 2 would be the tax-deferred side. Sure, there is a potential that guaranteed income, if other income is low enough, that guaranteed income that comes out of the annuity, distributions of the annuity, could also be low tax or tax-free, depending on how much is left in there and your standard deduction and your other income. So certainly that may be an option for you. And many people start with that annuity in the tax-deferred bucket and, like I said, convert it to Roth. Hardly ever do we want money in this taxable bucket, the annuities to be in the taxable bucket, because if your journey is a tax efficient journey, if you think taxes are going to be higher in the future, if this annuity grows, let's use that same $500,000 with a $700,000 future value, and that continues to grow. When you take distributions, you're going to be taxed, right? There's going to be a tax rate assigned to that. And that's going to be forever. Annuities are very, very tax inefficient outside of IRAs and tax advantaged accounts like Roth IRAs. Any growth has to first be paid as ordinary income tax. You don't get capital gains treatments. You don't get anything like that. And that tax rate is going to be applied on all distributions until you go back to your original amount that you put into it. And then what the big question is, what's that tax rate going to be? What is that tax rate going to be? And if you think taxes are going to be higher in the future and you're doing all this work to convert your money to Roth IRA, but you have this annuity in your taxable bucket and you're taking distributions from there, I always use the analogy of it's like pouring a fire hose into a leaking boat that you're trying to bail out. So ideally, we don't want annuities in this taxable bucket. We want them in the tax deferred or the tax advantage bucket. I hope that's all readable. I'm just taking a second to look at my board. So number 1 here, I'll just do it again. Number 1 here, number 2 here. I wouldn't even assign that a 3. Let's stay with the X. And if you have annuities already in that taxable bucket, there are ways to unwind that. We can, let's just go. You can contact us at questions@attleboroughwealth.com. That's questions@attleboroughwealth.com. So all is not lost there. It's just makes things more difficult. But now let's just say we have this conversion strategy, and we want to take a portion of this $500,000 and convert it every year over the next X number of years. Well, that sounds easy and it makes sense, but annuities are complex vehicles, so there are different calculations to be used. So we know that, let's use our example, a $500,000 annuity may have a future value of $700,000. So will the IRS allow you to convert that entire $500,000 and only pay tax on that $500,000 and not the $700,000? Well, the answer is no, right? You have to pay tax on the actuarial present value. It's called this APV, and these are complex formulas. I'm going to share a little bit of the where it comes from and the regulations, the tax regulations, and I'm going to show basically how it's calculated loosely and theoretically how it's calculated. But there's a couple things to pay attention to, and you should be aware. So you have what's called a fair market value and actuarial present value. So if you think about it, the IRS is keen on this. They say, well, wait a minute. You or someone else, your heirs are going to have a benefit of this $700,000, whether you take it as lifetime income distributions or whether it passes to your heirs via death benefit. So we're not going to let you pay tax just on that $500,000 when there's a future benefit of a much greater amount. But we're also not going to make you pay tax on that $700,000. It's somewhere in the middle there, and actually tends to be more to the left of the middle there. So let me share with you what the heck I'm talking about. So here's some excerpts from the tax regulations, so you can see here where it's coming from. And it reads, converting amounts to Roth IRAs. So what is the amount that is treated as a distribution for purposes of determining income inclusion when conversion involves an annuity contract? So I'll just read this to you. Notwithstanding the section, that's subsection 1.4084E, when part of all the traditional IRA that is an individual retirement annuity described in this section, or 408B, is converted to a Roth IRA for purposes of determining the amount includable in gross income as a distribution under another section, 1.408A4A7, the amount that is treated as distributed is the fair market value of the annuity contract on the date the annuity contract is converted. Similarly, when a traditional IRA that has an individual retirement account described in Section 408A holds an annuity contract as an account asset and the traditional IRA is converted to a Roth IRA for purposes of determining the amount includable in gross income as distribution under subsection 1.408A4A7, the amount that is treated as distributed with respect to the annuity contract is the fair market value of the annuity contract on the date that the annuity contract is distributed or treated as distributed from the traditional IRA. So that's a very technical way of kind of saying what I just said. But let's do, this is a Q&A that I pulled off of a particular annuity company's website, and I tried to snip it so that it didn't refer to that company, and I hope I was successful. So the first question is, why is fair market value important? The answer is fair market value for IRAs is reported to the IRS annually in IRS Form 5498 for IRAs and is used to determine the required minimum distribution amount necessary to satisfy mandatory distribution rules outlined by the IRS. So that refers to RMDs, and fair market value is important in that regard. Fair market value is also used to determine the taxable amount of the direct Roth IRA conversion, partial or full, from a traditional SEP or simple IRA annuity to a Roth IRA annuity. In general, next question. In general, how is the fair market value calculated for deferred annuity contracts? Fair market value, let me make this just a slight bit larger. Fair market value is calculated by taking the contract accumulation value as of a specified date, for example, December 31st, plus the actuarial present value of any additional benefits. The APV of an annuity must be determined using reasonable actuarial assumptions without regard to the individual's health. So if you want to get technical, you can pull up this. Or actually, I'll put this link in the description for this this section here. But you can pull up this link and you can read what the reasonable actuarial assumptions are. So how the APV is determined. Answer: each annuity company is responsible for using reasonable assumptions to assign an APV of the benefits offered under its contracts. Our calculation takes into account many factors, including age and the value of any income benefits, as well as death benefit provisions. Regulations clearly indicate that certain types of death benefits must be assigned a value. Most commentators agree that the regulations presumably also apply to certain lifetime benefits and contract value guarantees. Again, these income values and death benefits are contractually guaranteed, these minimum guarantees. So there is a value that has to be calculated when we're doing Roth conversions. It's not something that may happen. Somebody might say, well, geez, if I had a mutual fund or an ETF and I convert it, that same $500,000 or $100,000, and that could grow over time. Yeah, but that's not a guarantee. The contracts have some level of minimum guarantee, and that is what's used for that calculation. You could convert a mutual fund today or an ETF or a stock, and it could lose value tomorrow. But the IRS realizes and knows that these annuity contracts have some level of minimum guarantee that's going to benefit someone. The IRS and the Treasury Department believe that it is generally appropriate to reflect the value of additional benefits under an annuity contract, just as the fair market value of all assets generally must be reflected in value in an account balance under a defined contribution plan. So let me give you an example. I know that's very confusing, so I'm going to give you an example. And you don't have to calculate this, by the way. The annuity company calculates this. But I'm going to give you an example of a recent conversion that we did and what this looks like. So here is the snapshot of the confirmation we received. So your tax reporting information. It reads: a partial Roth IRA conversion results in a taxable event will be reported as required. So we didn't convert the entire annuity holding. We did a portion of it. And this tells us that the IRS Form 1099-R for the 2024 tax year will reflect the taxable amount of, in this case, this is just an example. This is not specific to you. This is just an example for education. It'll reflect the taxable amount of $270,999.24. 1099-Rs are mailed no later than January 31st of the following year. IRS 5498 for the 2024 tax year will reflect a converted amount of $270,999.24. 5498s are mailed no later than May 31st of the following year. So what does that mean? Remember, we have $270,999.24, which is our 1099-R converted amount that you're going to pay tax on in this example. Taxed amount. But if we look at the now accumulation value of that conversion, it's $255,906. So this shows us really, really well. So I'm going to put this on a kind of a line here. So we have contract value. You can't see it. Okay, contract value or current value, 200. And this example refers to it as accumulation value. So again, that's 255,906.33. In this case, they call this future income value or income value. This company calls it protected income value. That protected income value, the contractually guaranteed protected income value, so that'll be for future income withdrawals or death benefits. Well, and so we're going to call this income value and even death benefit. And in this case, they call it a PIV, protected income value. That is at $314,345. So this person wanted to convert. It made sense for them to convert $270,000, right, or $271,000 in this case. So their conversion amount is the 270. So that's 1099 amount. And that's going to be your fair market value based on your actuarially present value. That falls in at $270,999.24 in this case. So you'll see that the amount that you're taxed on the conversion isn't your current value or your account value or accumulation value, and it's not your future guaranteed value. It's somewhere in the middle and to the left of the middle. Now, some people I've had this discussion where people say, well, that doesn't seem fair. I converted I only converted $250,000 and I'm paying tax on $270,000. I think it's actually very fair because you have a future value of this $314,000 in this example, and you're only paying tax on that future value of on the $270,000 because it is it's not even in the middle, and it's certainly not $314,000. I know it's not $255,000, but it's also the rules. These are the rules and that we have to follow when we're doing Roth conversions. And again, you don't have to calculate this. The annuity company will calculate for you. Now, the thing that you want to pay attention to, though, is when we have, let's recreate our buckets in the time we have left. Let's recreate our buckets. So we have taxable, tax deferred, and tax advantaged. And let's say we have $1 million in tax deferred and 500,000 of it is in that annuity. As we work on this schedule, well, we're going to want to convert that whole $1.5 million, but we're going to front load the annuity, right? So these first few years are going to be annuity conversions, however long it takes to get those out. The reason being is that this gap for most contracts will widen. The difference between the account value and the protected income value, it starts depending on the company. So here we have current value, accumulation value is here, and then the protected income value or future income value or death benefit, is here, right? So that's the difference between the two. But as your years go by, this typically widens because we get some growth here, but the multiple is much greater typically on these income values and death benefits. So hopefully we have some good growth or decent growth on the annuity side. These spreads will widen over time, and therefore your fair market value and accumulation value, actuarial present value will also increase. And so this difference will widen, and you'll end up paying more tax as it goes, as compared to the account value. So I hope that makes sense. So that's one reason why we like to escalate these conversions in these Roth IRAs, because we want to minimize the amount of tax that you pay. The other reason is we want that tax-free income to come out as soon as possible for you. So it makes sense to do that. Now, the caveat to that is that, remember, the most annuities, certainly the annuities that we deal with, are principal protected. So if the annuity is invested in the S&P 500, or it follows the movement of the S&P 500, let me say, and you've got your $500,000 sitting here, and the S&P 500 ends up being down 20%, the worst that your principal protected annuity is going to do is 0% growth, right? So zero, you won't go anywhere below $500,000 unless you have some kind of fee associated with your annuity. But you might have other investments that are significantly down. So the reason we may shift from converting your annuities early on to shifting and going back to this other $1 million. Where the heck is my bucket? Other $1 million you have in your regular investments outside of the annuity is because we have an opportunity to move funds from traditional IRA to Roth IRA that now are have fallen because of the market. So we know we'll see a recovery in that at some point, as long as they're sound investments. So we might change in, let's say, this year and say, okay, we're not going to do the conversion in the annuity this year. We're going to take it from the regular investment account and we're going to move our $200,000 over from the investment account, because now that $200,000 can recover. So it's not an absolute. We do like to move these annuity dollars sooner than later because of that widening of the spread, but there are times that we do it differently. Okay. Whew. All right. That's a lot. Just like anything, it seems like I set out and I say, okay, this is what I think we should talk about this week. And I feel like it's simple in my head. And then when we start drawing it out, it becomes more complex. And that certainly is one of them. But I hope that was helpful. This is a complex situation. This is complex information. I hope I break it down so it's somewhat understandable. And I do have, So I was just told ads popped up 3 times overriding your presentation today. I had to click skip ad to get back to your presentation. Never had that happen before while viewing your weekly presentation. Well, I don't know, Keith. I'll have to check on that. I've never had that either. Hopefully you can see the whole thing in the recording, or I'll see how I can turn off those ads for you. I think rather than getting 6 cents from YouTube, I'd rather have you see the whole presentation. But thank you for that. Paul says only once for me. I hope they were good ads. And if you need to, you can go back and look at the recording because, again, this is important information, I think. Folks, this was, I hope you enjoyed this. I hope it was helpful. We'll see you next week. I think we have, I didn't mention this, but I think we have Thomas Byelich on next week, who leads our investment committee. That if that's the case, I'm going to let you know. But if that's the case, that will be a client-only webinar. So it may just be for our dear clients, because we'll talk about some details around investment management and our specific portfolios, and we don't share those with the general public. But I'll let you know, and you'll receive your notification. All right. Have a good week and take care. Bye-bye.